Hey everybody, this is Jake Borbage, Chief Investment Officer with Avidian Wealth Solutions, and I'm joined today with Robert Palmer, Head of our Financial Planning Department. Robert, this week we're going to talk about an article that both of us have recently read. It talks about Cathie Wood's approach to investing and juxtaposed to Rob Arnott's view of investing and how to pick stocks. You know, typical growth versus value discussion. I always find that interesting as an asset allocator. We typically will have a foot in both camps. But what were your first impressions as you read the article?
I think this is kind of a breakdown of where ideas and picking the right companies is where the tire meets the road. You know what I mean? Basically, you can have great ideas. There's no shortage of great ideas. And you could be right from a sector perspective, but if you pick the wrong companies, you're still going to underperform. And so I think that doing the right kind of due diligence and figuring out exactly what that means is paramount, especially given all the complexity in the economic environment that we're seeing now.
Yeah, and you know, you wouldn't. It doesn't take an expert to know that the growth style of investing has done tremendously well over the last 5-10 years.
Absolutely.
Value has struggled, right? That is something that we read about all the time. When you go down a layer, though, right? The ARK investment, the Cathie Wood style investing, it's growth, but it's also growth with a concentrated kind of thematic view. And then on top of that, there's stock picking.
That's right.
So as I was reading that article, you know, some things were blatantly obvious. The call about growth investing being the place to be over the next 5 years, right? That statement was made several years ago. That was omniscient, right? I mean, that was very forward-thinking and spot on.
Yeah.
The article goes a little deeper, talks about some of the subcomponents of growth, right? AI, technology, robotics, automation. Those are all places we've wanted to be, right? When we look at the performance of that strategy, though, the performance has not shown up where you would think, right? So there are some decisions that were very accurate, very correct, very directionally, you know, on the mark. Other things derailed performance, right? So, I mean, what went wrong? It's the stocks, right?
Yes, I think that's exactly right. I mean, Cathie Wood's back in 2021 was predicting an annualized growth of around 30% by focusing on these growth ideas. And the irony is that sector actually performed more or less in line with her expectations. However, her fund wound up underperforming by 30%. That is a big differential. And it just kind of highlights how you could be right about an idea, but picking the wrong companies, you could vastly underperform where you otherwise should be meeting the mark.
And I think when you say underperform, just to kind of contextualize it, the fund is down 30%.
Yes.
It's facts, right? You don't have to laugh at it.
Yeah, I know.
The fund is down 30% over the last three or so years, right? Or 28% in that ballpark. Broad market's up about 10% on average. So that's that's not just underperforming it by 30. And if we filter that down a little bit, so the broad market's up about 10% on average, the growth style of investing, or if we want to even get a little bit more specific, technology stocks up about 12 to 15% on average over the last 3 years. So those are big numbers and big gaps. And let's talk a little bit about the value side and what Rob Arnott does, right? So Rob Arnott, he's one of the founding fathers of smart beta investing. There's an ETF which I'm very familiar with. I used to have a lot of money invested in a prior life. The Invesco FTSE RAFI US 1000 ETF is one of the flagship portfolios that gives you access to that style, that value style, that non-market cap weighted style of investing. And that ETF, while it hasn't kept up with the broad market because it's value oriented, the construction of that ETF, it's very different, right? It buys a whole lot of stocks. I think it buys all 1,000 of the largest stocks.
Well, you mentioned beta investing. What does that mean?
So smart beta investing. So let's just talk about beta first. Beta is just getting market exposure. We typically think about that as S&P 500. It could be the NASDAQ, right? It's just buying an index. Smart beta is really just trying to take that index, remix it a little bit, maybe make it a little bit more diversified, maybe shave some of the largest companies off, maybe tilt that index to a particular flavor. It could be towards growth, could be towards value, but something that's trying to, add a little bit of intellectual property, a little bit of an intelligence factor to outperform the index. So thanks for pausing on that. So this ETF, it's going to own 1,000 stocks, right? So you're going to be very well diversified. You're going to have all the sectors represented. Whereas a technology oriented, the Nasdaq, you're going to be 50% in tech or tech similar type stocks, right? The odds that you get a theme right is much lower because you've got all the sectors. So you may get the call of value versus growth right. That's a call that's really difficult. Most people don't know when value is going to outperform growth. It's extremely hard to predict. I think it's something that's really difficult to predict as well. As a professional, I look at it every day. But the thing that really burns is if you got that call right, or if you bought the strategy that you expected to work well in that environment, like growth, for example, and then that environment materialized. So the call was right, you went in the right direction, but then the thing that you bought did not materialize with those returns. Well, that really hurts, right? Because you do all your work, you pick the right investment, and then the investment, you pick the right style, you pick the right theme, that theme doesn't deliver. What do you do then?
When you're both right and wrong?
Right and wrong, yeah.
I think, and going back to your point about the environment there, we had something interesting happening with value plays. When looking at what some of these value companies are doing, they're branching out into more technological arenas, sort of mirroring the same components, at least from a press release standpoint, that these growth companies are. You have a lot of value companies that are boasting things like AI, and they're sort of benefiting from that market sentiment in the growth sector. And so while they're lagging behind the growth sector, they're still keeping up to a certain extent. They're doing a decent job now. But when you're both right and wrong, what that tells you is that you got to monitor it very closely. And when you start seeing things go beyond a certain risk tolerance, you have to adapt. You have to pivot. And you have to figure out how to go about capturing that growth moving forward rather than waiting and waiting and waiting. Because, if you're too early, that also means you're wrong.
Yeah. And if you look at, that FTSE index, or that FTSE ETF, 1,000 stocks, the biggest market cap and the biggest holding in that is Apple. It's still a growth stock, but it's also a value stock, right? It's just the weight of that stock in that portfolio is about half what you'd get if you bought the S&P, probably a third what you get if you bought the Nasdaq. So it's really more of a question of portfolio construction, diversification. I wanted to talk a little bit about, so ARK is a great example, very newsworthy and notable example of thematic investing,
Yep.
of really getting a concentrated bet on a particular theme. But, since that style and since the AI theme has come out, there's been a lot of follow-on products that are also kind of thematic in nature. And they're also much more concentrated. And so what I was doing this morning is I was just kind of looking at, okay, what's the universe of those ETFs look like today? And how has their performance been, right? I mean, it could be just, Kathy got a few calls wrong, and that sunk the performance of that particular ETF. But there's a lot of other thematic ETFs that have done really well. And, when we do these podcasts, I like to use publicly available stuff so that if any of our listeners want to go and double check it or fact check it, they're able to do that. So I just went on etfdb.com, great free website if you ever want to do research on ETFs. And I was just looking at, okay, what other things are out there that have an AI theme, a robotics theme, a digital transformation type of theme. And then I also looked at just broad technology sector ETFs, right? So that's, I think the sector is going to do well, or I think a particular pocket of the sector is going to do well. Mm-hmm. What I noticed is that, the technology sector ETFs, they're right at the top of the list in terms of overall performance, averaging around 15+% per year over the last couple of years. The stuff that gets more and more specific is most of it's flat or down. Very poor performance.
What do you mean by that? The things that get more specific?
Oh, so if I'm looking at ETF and it says something in the name, robotics in the name or AI in the name, right? Those are things that are getting much more focused onto a particular theme, and you're taking that technology sector, you're boiling it down to an industry or a sub-industry or even a couple of companies. And so one of the areas there is a challenge is you're getting such a specific exposure and a laser focused exposure to a theme is you may just miss out on the real players in that theme, which has just been a couple of different stocks. The other thing I've seen these ETFs do that brings up another style of momentum, another style of investing called momentum investing, which is super interesting to watch how it's played out over the last couple of years. One of the reasons why the S&P is doing so well is because it's market cap weighted, and momentum investing is going to follow the stocks that have done the best. those stocks are also going to grow and grow and grow in a market cap weighted index. So today, Nvidia is over 7% of the index. Next biggest holding, I believe, is Apple. Right? It's kind of neck and neck with Nvidia depending on the day. Microsoft is way up there. They account for probably 20+% of that index, even though there's 500 stocks in it. You go to the NASDAQ, they probably account for over 30%. Momentum investing is a very powerful thing, especially when markets are trending. A lot of these smart beta ETFs, not to discredit them, they typically will use more of an equally weighted approach, and that means you don't allow your winners to ride, right? Your winners don't get that chance to continue to build in a portfolio, build position size. They tend to get trimmed as they outperform, which in some markets, choppy markets, that actually works better. But in a long trending market, that kneecaps the ability for momentum to drive returns in a portfolio.
That's what I was going to ask. The way you were describing momentum investing, it sounded very much akin to active trading almost, where you have to monitor everything, see where the market sentiment's going, and then continue to adjust wherever you see the momentum. How exactly does that work? Because I'm using momentum literally, but I want to hear how it's used technically.
Well, and I think it's, literally and technically very similar. If you think about the momentum behind any moving object, right, it's going to continue to stay in motion. In portfolio speak, that means a holding is going to continue to grow in weight until it doesn't. Now, to capture that in a portfolio, there's very little you have to do. Equally weighted portfolios actually take more day-to-day management, because if a stock moves up in value, you need to trim it back to bring it back to equally weight, because it moves up in value, it's worth more, right? It takes a bigger piece of the portfolio. In a momentum strategy, if a stock moves up in value, its targeted weight probably increased with that stock as well. So you don't really necessarily have to trade to bring it back down. It just, you allow that to continue to perpetuate through your portfolio.
Going back to Cathie Wood and Arnott here, we got a hot press release where she responds to this article defending her position. Specifically, she's stating that she believes in the concept of her investing strategy, and it's simply too early to crystallize these losses by selling and going into a new strategy. She's trying to convince her investors that they need to hold because there's another rally similar to what her fund did back during the COVID days that's about to happen, and they just kind of need to hang on there. What are your perspectives on that?
Well, I mean, kudos to her. I love when you see an investor show conviction in what they're doing. However, I think there are some challenges with that thesis. One is, if you look at the portfolio, the biggest holding I think is Tesla. I don't know if I would consider Tesla a deep value stock today, but there are lenses that you could look at Tesla through and say, based on future growth prospects, you could maybe twist that into thinking it was a deep value stock based on the future growth expectations, right? That's all dependent on what your expectations are going forward. Has nothing to do with what's happened in the past. But on the other side, I mean, we've seen Nvidia go on this tremendous run, and that is a once in a generation type of rally in a stock, in a technology, in a theme that you did not participate in for the most part through that portfolio. That will not come back. You won't have another one of those rallies. So you may catch the next rally, but that pocket is missing from that particular strategy. And, so I think there's a faith in the stock picking ability that you have to have for this particular investor. The way that we would approach it is if we're going to use active managers to build a portfolio, we are not going to let our success be determined by an individual active manager. We're going to find a team, and likely that's going to be some people from a particular shop, others with a different style or a different way of approaching it from another shop. We're going to put them together in a portfolio as opposed to loading up the portfolio on one particular style or one particular skill set of investing, which is what you're going to get if you load up into an individual ETF.
We've been talking a lot about growth investing, but I want to circle back to value investing. Where do you see the opportunity there?
So I think it's still something that has a very relevant place in a client's portfolio. Value investing, I don't think it's dead. I think it's been called dead. I think it's, the death has been called for many, many times. But the thesis that you can go out and get more for your dollar, whether that's, going to Costco and getting more stuff or going to the market and getting more earnings for the same dollar you invest, like that to me seems like a very sound thesis. It can't be completely blind of potential future growth opportunities, right? That's where you get stuck in value traps. But I think value investing will come back. The market will eventually, realize that there's actually some attractiveness to getting more earnings per dollar put to work, but per dollar put in the ground. But a lot of times I think, where did all the value investors go, right? Because there's a lot of skill there. And I think a lot of them, at least the investors that find those assets attractive, have gone to private markets. And private markets really, especially private equity, a lot of those strategies are based on finding companies that are going to give you more current cash flows per dollar that you invest, and then are going to provide growth opportunities in those cash flows, either through recognizing business efficiencies or unlocking some untapped growth avenues. But that is a fundamentally driven, value-minded approach, and it has gathered a lot of assets. It's done very well, even in relation to comparing it to small and mid-cap equities. Private equity investing has performed very well over the last 5 or 10 years, and I'm pretty sure it's outperformed the value style of investing in the public market space. So if your mindset is you want high cash flow generation in a portfolio, a private market or a private equity investment might be something you want to take a look at.
Well, Jake, I feel like I've learned a lot here. There's so much about the market that seems confusing to me at times, just by virtue of all the variables that are in front of us and all the news headlines that come out there.
If you have more questions, go to avidianwealth.com and look us up.